Welcome, Jerry. Welcome, Adam, and everybody watching later on at home. This is our live discussion for Cardinal Spirits, a company and deal very near to our hearts. Bloomington, Indiana-based distillery, craft distillery company. We're very honored to have Adam Quirk, the CEO of Cardinal Spirits, on with us live for what should be a really great discussion. For full disclosure, Adam is a DVC member of ours, has been from the very beginning, and a supporter of Dorio. So we're really excited to have this conversation, and I think this will give us a lot of really great insight and kind of as a DVC first direct contact and access to founders. We can continue discussions both in this call and in our DVC community moving forward. So we're really excited for this conversation. I've got a few comments I'll hold because I'm just excited to get into this. As a Indiana IU grad, and I think the rest of our community can identify with, Cardinal Spirits is a beloved Bloomington company, and so excited about this one. I'll hold there. Jerry, I'll pass it over to you maybe for a couple quick comments and a formal introduction of Adam, but we're really looking forward to this one.
Sure. Thanks, Dan. And welcome, Adam. To everyone.
Thanks.
As a member of DVC. As you know, our mission is to really break down RegCF deals across all platforms to give you the best information on the most relevant information, both pros and cons, so you can make a smart investing decision. Our longer-term mission is obviously to invite founders to participate in DVC Club if they're going out for an offering, to come and speak to our members in a Q&A format, because they're looking for guidance, and they're looking for maybe insights that they just can't glean from just what's being posted on the platform itself that has its own limitations. So with that, Adam, who in disclosure is a friend of mine, I've known Adam for a long time, well over a decade, is a member of DVC, and he has a very prosperous distillery with his co-founder, Jeff. And for the first time, they're sort of ready to open this up to the world and to their customers to be investors. And I couldn't be more excited about this, because when you hear the story of where Cardinal Spirits started to where they are today, it truly is an example of the type of company that should be raising RegCF money. And yes, I am a homer from that standpoint, but I do know the company very well, and I've seen it operate from the very beginnings. As a matter of fact, I can remember sitting at a cafe with Adam. Oh gosh, this is what, like 2013 or whatever, 12, and it almost is just sort of drawing the blueprints of what a distillery might look like. And then a year later, I saw a building. I'm like, wow, okay, that's what and today they're in various lines. They're in the more cutting edge areas of sort of this canned cocktail movement, and they've got a great story to tell. So with that, I want to introduce Adam, who's a co-founder. And maybe Adam, why don't you spend the first few minutes just kind of giving everyone an overview about Cardinal Spirits?
Yeah, happy to. Thanks for having me. I love this. As you mentioned, DVC founding member, and I just love the mission, and I think it's great to democratize venture capital. So I'm excited to potentially, to pitch to the DVC group. And so, I'll give you a little background about Cardinal. So we started the company in 2011. Jeff and I met. I was coming from New York. Jeff had been in Bloomington. We had similar ideas about wanting to start a distillery. Bloomington seemed like a great place to do it. There was not a current law on the books to allow a artisan distillery in Indiana. So part of the parallel path we went to creating Cardinal was also to lobby the state government to actually create a law allowing us to sell direct through the tasting room, which Jeff is really good at. And so around 2013, we had that law kind of drafted with some other Indiana alcohol producers, pitched that to the State House. That went through the process and got passed, and then went into effect in July. And that's about when we started fundraising for Cardinal. So we kind of had to do both at the same time. We had the business plan, we had the models ready. And so basically in July of 2013, we started pitching to local investor groups. We ended up raising about 850,000 in equity from private investors and around 750 from a bank. So German American was able to finance our equipment and some build out. And I will say that was the 8th bank that we went to. The first 7 said no. So if you go to a bank and they say no, just keep trying, because eventually the way we were able to work that out was pretty cool. Actually, we said, look, we're going to raise some money for working capital. We're going to raise 850. And Mark Franklin at the time said, hey, if you can raise 650 in equity, I'll fund 750 in debt. And so we were able to sort of play those two together, and ended up raising enough to get the business off the ground. So long story short, we got the money in the bank, started building out our facility, which took about 16 months or so. And then we opened in February of 2015. We only had vodka when we first started. Vodka is the easiest thing to make as a distillery. And so we had vodka, and we opened our tasting room and sold out of all our vodka on our first batch in like 3 hours. So that was a pretty crazy night. I remember we had a bell hanging. We just rang the bell. It's like, everyone, sorry, we don't have any more booze, go home. So that was crazy. And then we pretty quickly started releasing all the other products. We had a pipeline designed pretty much for that first year to get us up to 8 products, actually. So we had gin, a coffee liqueur, Bramble, which is a black raspberry vodka, and some other products. And so we released those every couple months and got to the point where we had a pretty good portfolio. And then, yeah, we really just started distribution in Indiana. We had a smaller distributor that we started with, who helped us get into bars and restaurants and a few independent retail chains. Those of you in Indiana know Big Red is the biggest chain here, and they were very supportive from day one, placed a good size order, and started growing that distribution footprint. And really for the next like 18 to 24 months, we were just focused on Indiana. Moved into Chicago and then New York, where I had spent most of my 20s, and started distributing there, and really just kind of taking a step back. We've gotten to the point now where we're in 13 different states and DC, and we have over 8,000 points of distribution around the country. So that part of the business has grown well. Obviously skipped over a lot of stuff there, but we launched our RTD, our canned cocktail line, in 2018, which was really the start of the wave of that category. There were a couple other products on the market at the time, but no big winners, and there still really aren't any huge winners. I mean, when you're talking about spirit-based RTDs, you've got High Noon, which is a Gallo product. You've got Cutwater, which is a Constellation product, and then everything else is almost like a regional play. And so we're really focused now on driving our RTD sales in the Midwest. And in this market, we've really become known as like the craft premium RTD brand. There's a lot of interesting stuff we can go into there, which I'd like
Adam,
to.
Is that just quickly, is that taking market share away from beer drinkers, or what's the demographics of the market for canned cocktails?
Yeah, I mean, it is. We've definitely cut into beer for sure. Canned wine and canned spirit-based cocktails and then canned seltzer are all three kind of taking share away from beer over the past 4 or 5 years. Yeah. And canned cocktails, separate from malt based. So like if you think about Truly and White Claw, those are really a beer product. They're like a heavily filtered beer, malt beverage.
Like Zima back in the day?
Yeah, exactly. Yeah. Or even Smirnoff Ice, which is, Smirnoff's a vodka brand, but that's a malt product. So the spirit-based RTD canned cocktail segment has grown like 55% compound annual growth rate for the past like 4 years. So it's just really taken off, and we've actually grown at like 65%. So we're like just a little bit above the trend there, which is nice. So yeah, that category is incredible. We're excited to be a big part of that in our markets. The other two pieces of our business, so we have three main revenue streams. We've got the branded side where we do spirits and canned cocktails, and then we have our tasting room, which is based in Bloomington, around 100 seats, and top line $1 million a year. It's not a huge part of the revenue picture, but it's a really big part of our marketing and brand story. People come to IU for so many different reasons, whether you're a student or a parent or, for a conference, or there's just so many, there's, over 1 million visitors per year to this little town, Bloomington. And so they come experience the brand directly. We do tours, tastings, cocktails, food. It's graduation weekend here. So, we're super busy. But they take the love of the brand back with them to Chicago, New York, all these other places around the country. So it's a really great seed for falling in love with the Cardinal brand. And then the third revenue stream, which is actually about 60% of our total top line, is contract bottling. We call it Copacking. And we've actually been doing this since day one. It's always been part of the model. We produce, package, bottle, and ship out products for other brands. So the majority of these customers, clients, are existing spirit brands that have some products that they don't want to run through their high-speed line or their high-speed co-packer. They may have a brand that's doing 1 million cases a year, but then they have a single barrel product that's only doing 100,000 or 20,000 cases a year. We're really good at that. We do the hands-on stuff, the hand labeling, wax dipping, all these things that are important in the spirits industry for good presentation on the shelf. We specialize in that, and we do it really well, and we do it really fast. And so we've been doing that, like I said, for 8 years now since we started, and it's really become a big part of our business. It's, like I said, 60% of our revenue, divided across about 20 different clients at any given time. And, like I said, some of these are big brands that you've heard of. Some of them are startup brands that are started by companies that you may have heard of. So the one thing that we've learned in that process is even if you don't know much about the spirits industry or CPG in general, if you have a good marketing background or an audience, so like specifically online influencers, celebrities. One of the big brands that we worked with in the past few years is St. Elmo's, which is a steakhouse in Indy. They do tons of business. They're like a well-known entity. We created a bourbon for them, and it grew so fast. We did like 10,000 cases in the first year. It's continued to grow. We created a Elmo Cola cocktail for them. And then they actually just built their own distillery. They were like, this is great. We're in it. And so they like graduated, which is, it's cool. So brands like that are really, we see a lot of success with those folks, people who already have a market and an audience. And then historically, we've also done some sort of like startup brands where, you may be an attorney or someone, you have an idea for vodka. You come to us, we help you develop it. What we found for a lot of those is, if you don't have the experience and you don't have the market already, it's a really tough road to hoe. So we've kind of moved away from some of that stuff. And we say, like, look, if you can.
In essence, you're kind of serving as an accelerator, that you're already vetting these deals.
Yeah.
Because in your experience, you're trying to figure out, it's all about placement on the shelves and then pull through. And getting distribution is very hard, but then needing to get consumers to pull through is even harder.
Yes.
So you're making those decisions all the time. Yeah.
That's exactly right. I mean, on a daily basis, really, Jeff and I get emails about, I have this idea for a brand. I have this idea. And it's, I love it. It's like you said, it feels a little bit like, running an accelerator. But that is the huge problem, is like, you have this massive amount of brands over here, and they all have to go through this little eye of a needle that's distribution. And, it's a 3-tier federally regulated system in this country. So you have to have a distributor if you want to sell to a retailer. And they're just, there's been so much consolidation in that world that they don't want new brands unless it's like unless it's a celebrity or unless it's a
So
well-known
when,
entity. Yeah.
yeah.
So yeah.
Can you, two questions on your co-packing side, since we'll start there financially, because it's 60% of your company or your top line revenue. What are the margins for co-packing, generally speaking? And then are you at capacity, and how much room do you have to grow? How much room do you have going forward with your existing capacity, or would you need to actually expand your facility to expand capacity?
Yeah. Okay, so gross margins like 20 to 25% generally
Mhm.
for co-packing, which is good for that kind of manufacturing.
Right.
Like I said, we tend to be most effective at the sort of mid-volume, high-touch kinds of products. And so we can charge a little bit more for that. We're not really competing on price most of the time. We're competing on efficiency and quality, which is, that's where we want to be. Capacity wise, we got to, close to 100% capacity last year, which is one of the drivers for this investment round. We wanted to add some new equipment and some more space. So we were in 18,000 square feet last year. We moved in December, January into a new facility that's 28,500 square feet. It's over on the west side of Bloomington, over by Ivy Tech. And then we also spec'd out two new pieces of equipment. One is barrel dumping. So, it's basically right now we're lifting barrels with a forklift, dumping them. This is like the way most small distilleries do it. But there's a process where you have a trough, basically, and you can roll a bunch of barrels on there, dump them all. We got that designed. We're ready to put the down payment on. And then we also have a high-speed, a really sophisticated, interesting, high-tech bottling line that we've been speccing out with this manufacturer. Because we do co-packing, we don't have just one bottle shape and one size. We have multiple shapes, multiple sizes, and that's just not what these machines are generally designed to do, because they like speed. They want to have it, really easy. You do one changeover, it might take 6 hours, and then you can run all these things. We needed really fast changeover, different label shapes, all this stuff. So we got that designed, and then we actually submitted a grant application to the IEDC, the Indiana Economic Development Corporation, in January, and just learned last week that we got like a $200,000 grant towards that for their advanced manufacturing grants. So,
Oh, wow.
pretty exciting. Yeah.
Yeah, that's awesome. So one more question on the co-packing side of this. So obviously inventory, carrying costs, that kind of thing. How are you working with your customers about them about receiving payment, and who's holding onto the cash, and how's that work? Because it can get expensive, right, to be carrying inventory for these customers.
Yeah, well, and it's a case by case basis. We've tried to systemize some of those things where, hey, this is the way we do this, but inevitably different companies have different suppliers. Some people need us to source bottles. Some people have their own bottles. Some people need us to source the neutral spirit. Some people have their own supplier. So as much as we'd love to modularize all that stuff and systemize it, that's not the way this industry works. So just to kind of high level it, like case by case basis, we just, we have to play it by ear. As far as the cash goes though, we generally charge anything that we're bringing in raw material wise, they're going to pay for upfront before we make that PO. So that's just, that's the way we do it. That's the way a lot of people do it. So that's pretty standard. And then as far as like production goes, let's say we're doing a week worth of running for some brand and we're doing 500 cases a day. So 2,500 cases. What we'll do is we'll say, put down 30% right now. That'll get you slotted into the schedule, and then net 30 after production is when you owe the rest. So it works out pretty well. Some brands, some products, or some companies have their own financial controller who wants it a certain way. These are the bigger companies, and we kind of have to say, all right, yeah, that works. you pay us a lot of money, so we're just going to let you do it your way. But when we can control it, we try to do it that way.
And
Yeah.
Adam, on the co-packing side, how do you look at growth in that department? Because obviously it sounds like that move to the new space gives you a lot more production capacity, but it's interesting the setup where you're not necessarily, like you said, you're being kind of selective. You're not taking in every new startup brand that wants to come in. So when you're looking at growth, is it more kind of growing those brands that you've already incubated into that capacity, that new capacity that you have? Or are you now kind of looking to branch out and take on some of those new companies who you might not otherwise have maybe considered earlier on?
Yeah, it's both. I mean, it's definitely easier on both parties if we can just grow an existing brand or like add a line extension to some product they're already making. So that's great. As far as, so two things there, capacity wise, yeah, we have 10,000 more square feet, which is space is always an issue in a distillery. You have barrels, you have glass, you have full truckloads of all this stuff that you have to put places. So that's great. The bottling line though is we can go 8 times faster with this advanced line that we're going to be getting. So we did 130,000 cases last year. Close to 1 million cases is what our top line max is going to be now. So that's just going to move the constraint, right? I mean, the filler was the constraint. That's going to move the constraint to, I mean, it might be space again. It's probably going to be space again, just literally bringing in a full truckload of glass, running it through this line, pushing finished goods out the other side. You're going to have a backup there. So we have plans this year to try to get to about 50% capacity by the end of the year, to get to 50%. So, it's a big lift, but we have so many people that we've turned away because of speed issues. Like I said, we've really focused on this high touch, low to mid volume play. Now we can go into some of these brands that are doing 100, 200,000, 300,000 cases a year. We can be competitive on price because we have the speed. So that's the cool thing about this line. We can still do all the high touch stuff that's really profitable, but we can also run high volume.
And then, so 60% of revenue currently is how much in dollars?
Like 4 million a year.
4 million a year in dollars. Okay.
Yeah.
So let's switch over a little bit to your other two sort of paths. Which area would you like to talk about first, and what does that look like, and how are you projecting and looking at the future?
Yeah. So, I mean, I think the most exciting thing for me, and I think Jeff and I are good partners because he's more excited about bourbon and I'm more excited about canned cocktails. And so we're both really excited about the two big growth opportunities. So I'll talk about canned cocktails first. Like I said, we got into that in 2018, and we've seen just in the past couple years started to see a lot more M&A activity around these brands. And so Fisher's Island was our one that we had our eyes on. They're a New York-based canned cocktail company. They do like a whiskey lemonade, and they launched about a year before we did in 2017. They just got to 100 and something thousand cases last year, I believe. Now they're at maybe 120, and they just got either acquired or heavily invested by one of these big, I think it was Diageo or Constellation. So seeing those deals starting to come is exciting. Everyone knew it was going to happen, and it's just a matter of time before these things start getting picked up. So that's really been our goal. We're really focused on growing that. We've improved margin quite a bit from, we were like 15-16% to now we're close to 40, even above 40% gross margin on some of those products. And along the way, just getting tons and tons of chain placement. So we got a really strong sales director a couple of years ago named Kyle Geis. He was actually trained at Gallo and then worked through an Indiana distributor, and then we hired him from that distributor. And so he's gotten us into CVS and Walmart and all these brands, all these big chains that we really didn't have access to because he speaks their language, and he just knows how to make those large placement sales. So yeah, even just like last week, we got 60 more CVS placements for our canned cocktail variety pack. So we were in 116 last year, so now we're in 180 something, and that's just in Indiana. And so that part of the business is growing really well. I've really become like an RTD spirits nerd, like looking at all the different data coming out of these reports, and it's kind of mind-blowing to me how the purchase decisions are happening for these things. So the vast majority of purchasers are 25 to 35, and flavor is the number one driver of decision. Number two is alcohol content. So the higher the better, basically. Like, so we're 8.5% on the double vodka soda and the bourbon cream soda, which are two of our best selling canned cocktails. And then price is like number 6. So it's like all these things are driving decision, and then cost is it doesn't even come into the top 5. So that's been very helpful for me when I'm talking to distributors and retailers, and they're saying like, I think we just need to do like a discount, get this down to $19.99 for your 12 pack or something. Like, no, I don't think we need to. That's not what's driving this decision. All we need to do is make the ABV bigger,
Yeah.
And that's actually worked. We did a big program in Total Wine and Spirits where we have this, we have a canned cold brew, spiked cold brew called Songbird, and it's 8.5%. And so we had these signs, and 8.5 was really little, and it was selling okay. And then we just made it 8.5%, like as like a quarter of the size of the sign, and sales took off. So it's a proven method.
Wow, that's great. And then, so thinking about that market and that industry, I mean, what are you projecting growth wise, or what are you seeing? You said there's no major player and there's no dominating player, so there's still regional, which speaks to me of opportunity to expand.
Yeah.
What is your plans for? How are you guys thinking about gaining even more, mind share around this? Is it more options, or is it just doing sort of tweaking the brand and positioning? Where's the lowest hanging fruit, and what are you thinking about this for 5 years from now, the size of your canned cocktail market?
Yeah. So a couple things. Number one is, we have 13 states and DC in our distribution footprint right now. The Midwest is really where we're going to be focusing more of our energy, and we really have started that up to maybe 8 or 10 months ago is when we kind of pulled back from sales and marketing in the Northeast, where it's very expensive and we don't have as deep a footprint, and refocused our efforts in the Midwest. And so that's number one, refocused on the Midwest. Two primary reasons there. One, it's easy for our sales force to get to all these accounts faster without an overnight hotel and flight. And then number two, and I think really this is the primary driver, all of the folks we've talked to in M&A and these larger companies are really excited about the idea of a regional brand, and grabbing a regional brand that has really deep penetration into, let's say, the Midwest or the Southwest or whatever it might be, and then taking that playbook and expanding it out around the world where they have distribution, right? So strategically, it makes a lot of sense for us to just kind of focus on the Midwest, where we already have great traction and where we live. So that's number one. Number two, we have really not even scratched the surface on premise. So event centers, music centers, bars, restaurants, golf courses, places where the product is consumed, where you purchase it. We've really been 90% focused off premise. And a lot of that was driven by COVID in 2020. No one was going anywhere anyway. So everything was going through grocery and liquor store. And so we already have a good footprint there, and that's where people know to buy us. But we just have tons and tons of greenfield for on-prem now. So just next week, I'm going out and talking to a bunch of golf courses. Kyle has put me in touch with a bunch of restaurants. So we're going to be doing a lot more on-premise sales this spring and summer. So yeah, lots of opportunity there. As far as like 5-year plan, we're really focused on like our 6-month, 1 year, and 3-year plan. 3 years, we really want to be over 100,000 cases a year. And I think we're gonna beat that, but we have a plan to get there. What we found is like around that 50,000 case a year number is when the M&A folks will start calling you instead of you bothering them. So we were like right over 30,000 as of last year. So we think by the end of this year, we'll be hitting that 50,000 mark. And so, maybe we take a minority investment from one of these larger players who helps us get to that 100,000. So strategically, that's really what we want to do. We want to build the canned cocktail brand to a point where we can divest it and keep doing all the other stuff that we like to do.
And what's the biggest challenge, Adam, in scaling up to that level? You said you're at roughly 30,000 right now, or just over that. I guess trying to get to that 50 level and beyond, what's the biggest challenge? Is it marketing and the sales process, or just, again, capacity on, what you can produce alongside the other streams of your business?
Luckily capacity isn't that big of an issue. So we have one co-packing partner on the canning side, Upland here in Bloomington. And then there's a couple others that we've talked to and worked with. So we can scale that up pretty easily. And we have great relationships with our vendors, so we can scale up the material orders really easily. It's sales and marketing, and that's a huge category. So to try to like pinpoint that, I would say what's number one, it's distribution. Like distributors are, it's just very hectic right now. There's a lot of consolidation, a lot of big brands moving around to different distributors to try to maximize their efficiencies. And like in RNDC is our Indiana distributor. We're with them in Indiana, Kentucky, and Michigan. And they just lost Sazerac earlier this year. And so they're working on getting another big partner. So it's just like that's been happening across the country, across the category. Just a lot of turmoil. And so getting attention is really hard. We've really found that we have to do a lot of that sort of groundwork ourselves. So even like, not just Kyle talking to the chain buyer at Meijer or Total Wine, but literally going into Big Red and making sure that they have like products on the shelf, which is,
right.
That's
right.
Not really what a supplier is supposed to be doing.
Yeah.
But if we don't do it and they don't do it, then it doesn't happen. So,
and is there a broker business out there where they can do that for you? But that eats into your profits as well.
It does, yeah. And you have to do it in some cases. So yeah, we had a merchandiser. We had 2 merchandisers in Indiana. And we're probably going to have to get one more. So we'll have to do that, in certain markets, especially the home market. We want to make sure that we're looking good on the shelf, right? If it's not on the shelf, you can't get a depletion, right?
Yeah.
Right.
I've mentioned this before to our DVC membership, but I had a very brief career kind of in the bottled water industry of all places, and doing that exact thing of, you're in sales, but going in and you got to make sure it's on the shelf, it looks good. And that was in, again, bottled water. And you're obviously working in a space that's way more interesting than that, and way more differentiated. But even that, I understand the challenge of, it's boots on the ground, doing that hard work to make sure it all looks good. And then you build those relationships too. So yeah, I definitely understand the challenge there. And I respect how much more interesting this is than just bottled water.
Right.
So really quickly, so canned cocktails around 30,000 cans a year right now, looking to go to 100,000. What's that look like revenue right now currently for the company?
So canned cocktails are at 20 something. Our total case volume, including spirits, was 33, right? So 20,000, and we're, usually it's like $38. So call it 750 for 750,000 in revenue. last year in canned cocktails.
And you're looking to take that up to 2.5 million,
Yeah.
roughly,
Yeah.
over the next 3 years.
Yeah.
Yeah, got it. Great. And then let's talk a little bit about bourbon. This is sort of the last area
Yeah.
that Jeff is super excited about, and it's a good product. So
Yeah. Yes. Yeah. It's amazing to me how, bourbon has been growing steadily since we started in this industry. And everyone in the industry keeps thinking, oh, I think I think this is the year it's gonna taper off or plateau, and it just keeps going. So it's crazy. So yeah, bourbon, we produce anywhere from 20 to 30 barrels a year. It's not a big part of our program right now. And so getting a couple pieces of equipment to finance more bourbon production is part of this round as well. Getting a chiller and some more fermentation equipment basically is the main thing. We have 2 stills, and those are both not at capacity, so that's not the driver there. Yeah, and I think like I said, we've had bourbon on the market before. We've had our best-selling bourbon product is actually our canned cocktail called Bourbon Cream Soda. And historically, we've sourced bourbon for that product through MGP, which is a large distillery in Lawrenceburg, Indiana. It's a very well-known distillery in the industry. A lot of rye and bourbon come out of that place. And the prices are great, but they acquired a company a couple of years ago, and have been rerouting a lot of that supply to their own brands, and so they're not selling as much wholesale. So we really needed to make sure that we're putting down bourbon right now for the next year, 2, 3, 4 years. So we've ramped up our production already, but with a additional investment, we'll be able to put down more barrels and get to a point where we're basically supplying all our own products with our own juice.
that's great. So let's sort of, I know we only got a few minutes left here, let's call it 10 minutes. So overall, let's talk about, okay, top line revenue. Are you cash flow positive? Are you cash flow neutral? Are you burning cash? What's your current runway? And then we'll move into the raise and talk about the raise.
Yeah. Currently burning a little bit, not much, but we're probably, I would say, like a month away from cash flow neutral, because we've got a lot of co-packing work in the pipeline right now that's going to start coming in towards the end of this month. And so net 30 from that, we're going to start getting that cash, and we'll be positive, which is great. I mean, we've been working towards that for a long time. We've had months and quarters in the past where we've been profitable, and even all of 2020 basically, but we haven't been able to do that consistently. Last year we made a lot of good decisions on the cost side, and I think we're a leaner, meaner Cardinal now, and very, very efficient. So with the same amount of co-packing work, we're going to be profitable starting basically in June, which is great. Yeah, so that's, as far as runway goes, we got plenty.
And how do you view profitability and reinvestment after that? Because a lot of the deals we look at in DVC here are standard software tech startups where either they're profitable but reinvesting entirely back in the company. Vast majority of them are not profitable, and they're very much employing the burn, to grow strategy. How does it look for a business like yours? Obviously very different than a software company. How does that look for you guys? And when you do reach profitability in June, what does that look like for growth and for you guys moving forward?
Yeah, I mean, it's we'll reinvest profits certainly for the rest of this year, and I think our like I said, our main goal financially is really to get to the point where our canned cocktail brands we're getting 100,000 cases per year. At that point, we will have we'll have a good amount of profit, or we'll have an acquisition interest. So either one of those things will trigger a decision whether we sell that and then distribute those profits, or we start distributing profits from our own cash flow.
That's
Warren
great.
Buffett likes distributions.
Yeah.
Dividends.
Yeah.
Okay, so top line revenue is roughly how much right now? What are you projecting for 2023?
Top line for 23, I think is like around 8. So we were at 6 last year. Yeah. And
Okay.
so with the additional equipment and growth on the canned cocktail side.
Okay.
Yeah.
So, and then, so still growing. And now let's take a look at this raise. You're doing a raise on WeFunder. You're going to open this up to your customers and really expand your, potentially turn investors into customers and vice versa. And, one of the things that we like to see at Dorio Venture Club is when a company comes to the table to do a RegCF offering, and they've disclosed their current financial situation and where they are, which you've done, but they come to the table with more cash, priced, and the CF investors are coming in at a same level.
Mhm.
And so what I understand from you, I mean, you could talk a little bit about this. You've got existing investors that are pumping more money into the company, which is always a great sign. And
Yeah.
then you've gone out and you've talked to a few angel groups. And so how much have you lined up through Reg D as a sort of a parallel strategy to your RegCF campaign?
Yeah, so we've this whole round, both with current investors and the RegCF, is a convertible note, and with a $20 million cap. And so what we've done is the first for the RegCF side on WeFunder, the first 100,000 in is going to have 8% interest, and then anything after that is 6%. So that's that part of the deal. As far as what we've raised, so we did about 800,000 before WeFunder. We did about 800,000. 6 of that was existing investors, and 200 was new angels. So we pitched IU Angel Network and some other local investors, and we're able to get commitments of 200,000. And actually, some of that's already closed. And so now we just started WeFunder. We just started emailing folks last week, and we already have 25,000 in there. So there's another 75 left for that first 100,000, 8% bonus.
And to clarify, the money that you've closed has not been spent, correct?
Right,
It's
right.
sitting in the bank account, because we've
Yeah,
seen
yeah.
companies that have said, oh yeah, we've closed or we've got these commitments, but yet the money is actually already spent.
Sure.
In a lot of cases, up to a year prior, they'll say we're raising at the same terms and we're bringing that in, and it looks on a lot of the platforms like it's
Right.
being raised at that exact same time, but it's already been spent a long time ago. So
yeah, and so to clarify this, we have a company here that's doing is projected to do $8 million in revenue this year, so between 6 and 8, and you're almost cash flow neutral, so you're not burning cash, and you've got already $800,000 sort of in the coffer, so you're dry powder, and now you're opening this up to the RegCF. So all of the RegCF money is coming in a very safe funding round, because we're not trying to prop up a company. We actually are part of the growth story. So this capital is for you to go out there and really try to, triple top line revenue over the next 5 to 6 years. And then that gives the company a lot of options. An M&A, right? You could sell off pieces of it and return capital back. You can maintain your co-packing business and expand that. So there's a lot of different options for investors, which makes, in my opinion, seeing a lot of these deals, it makes this a very exciting opportunity to jump into the deal. And this is why we agreed DVC for Cardinal to be the first company that we would lead an investment on. Is that a fair statement?
Yeah, for sure. Yeah, absolutely. Yeah. And I think, as much I've learned a lot about RegCF in the past couple of years, thanks to you, and it's just such a great place. I mean, giving your customers upside is just such an awesome idea, and it's mutually beneficial, right? I mean, we're going to have so many more brand ambassadors now than we could have ever hired, right? And so yeah, we're super excited about it. I think, you know, we're capping the deal at like 1.2 or something like that. I don't know if we'll get there. We have about 40,000 people on our newsletter and social media, so some percentage of those folks will come in. And then I've been learning a lot about the WeFunder algorithm, so I think we're going to be pretty well set up once we go public to get some traction there. But yeah, we're super excited to open this up to regular folks like me.
Yeah,
Well, there's a
that's
lot
great.
of love.
So-
There's a lot of love for the brand. I mean, my couple of my classes, when we ended my senior year, we all celebrated at Cardinal. Seems like every apartment I go into in friends' places in Chicago, you know, they keep Cardinal and they carry it with them well past the IU
Yeah.
career. So there's a lot of love for the brand, which is cool to see.
That's great.
Well, I think that's really, you know, all that we wanted to cover. And so this is going to be for club members. We have an opportunity to get in before on the early bird terms. So another couple points on the note, which is great. I personally just believe that this is, and I'm not recommending anyone to make an investment. You do your own thing. But from my experience being a professor of entrepreneurial finance for the last 20 years and the myriad of deals that we've seen on RegCF, that this is definitely one of the stronger opportunities that we've seen in terms of risk and then potential upside. So congratulations, Adam. You've done a great job. You and Jeff have done an amazing job getting this off the ground and just getting it to where it's going. I think you've got vision about where you want to take it, and I think there's going to be a lot of options. So congratulations.
Thanks, man. Yeah, and I'd love to open up, jump on Discord at some point and open up questions if you guys are interested.
That'd be
we
great.
can find a time to do like an AMA or something.
Absolutely.
Yeah, that'd be great.
Cool.
Awesome. Dan, I'll turn it back to you.
Wonderful. That's it for me. Thank you very much for the time, Adam and Jerry. This will be great. I know our membership is going to love this, and appreciate that, Adam, the opportunity to open that up further on for continued questions and discussion, because I know there's a lot to talk about. We probably only touched on a very small portion of everything going on with the business. So very exciting. Really appreciate the time, and we'll keep this discussion going.
And thanks for
guys.
thinking of us for the lead.
Absolutely. Exciting.
Yeah. Thanks, everyone.
All right, thanks, everyone. See you.
Thanks.